Welcome back to the Jack Tomczak Show. This is Dr. Kent Kaiser substituting for Jack, who is out for the day. And along with me is Jill Voyevich-Lobbs from the Minnesota Republican Party. And we have another guest who is one of my favorite people in the whole world, Patrick Brenner, who is the president of the Southwest Public Policy Institute. And he is a real public policy animal. If you ever thought that public policy might be boring and dry, you got to hang out with Patrick Brenner. He is one of the funnest people to hang out with, and I really encourage you to look at the work that he's done. And he's here today to talk about an issue that I think is really important on the economic side, which is interest rate caps. And all across the country, we have had efforts to put interest rate caps in place, which are well-intentioned, supposedly to help poor people not get into as great a debt, but it in fact takes away opportunities for them to get any credit at all. Welcome to the show, Patrick.
Dr. Kaiser, I don't think I have ever had such a flattering introduction. Thank you.
Well, you deserve it.
Pleasure to be here.
No.
Oh, well, I mean,
appreciate your work.
You and I we have a great time whenever we're together. And the last time that was in D.C. earlier this year. We had a good time hanging out in that hotel lobby at that conference.
CPAC.
That was fun.
Yeah.
No, thank you for bringing me on. Thank you for inviting me to be here. It's a pleasure to join you and the rest of the Minnesota audience listening. And I can't believe the state of interest rate caps and price controls across the country. Now specifically, let's break this down. Interest rate caps exist in the alternative financial services sector. What does that mean? That means like when you're looking at acquiring a credit card. Credit cards generally don't have interest rates in excess of 36%. And in the alternative, like subprime segment of creded access, what we saw in New Mexico before the 36% rate cap was applied it was previously 175%. And the market was responding favorably well, meaning there was supply of credit, it was ample supply of credit, people were using this credit knowledgeably, and supply equals demand, and there was no problem. But then you have this interest rate cap that comes into effect in 2022 that was voted in by the members of the legislature here in New Mexico. That went into effect it was voted on in 2022 and went into effect in 2023, and that effectively destroyed the subprime credit market in the state of New Mexico. So much so that even today we're still seeing some of the negative repercussions of this. Sure, it's well-intentioned policy, but it's not good. It's not free market. It doesn't take into effect just like the economics 101 aspect that a credit rate cap is in effect a price control on the price of credit. And when you institute a price control, it impacts the equilibrium point where supply no longer equals demand. You've got a shortage. And in the event of a shortage, as we're seeing right here in New Mexico right now, we just published another report called Black Market Payday. Right now, there is a Democrat former member of the New Mexico legislature that is facilitating a subprime payday loan scam to her own employees. She's able to do this because there's no market for subprime credit anymore. And she's lending money to her own employees at interest rates in excess of 2,700% APR. That's 2,700% APR, Dr. Kaiser.
Yeah, that is crazy. Well, and we've seen these things happening all across the country, and the impact. It's interesting to see the impact of these interest rate caps. One of the things we saw in Illinois was that when they implemented the interest rate cap, that forced people to take out bigger loans. And then, of course, if you give people more money, they spend it. So then they wind up in more debt. And so that it did exactly the opposite of what the well-intentioned legislators had in mind, which was to help people not get into great debt. Because the small dollar loans went away in Illinois for all intents and purposes. And so people were steered into these bigger loans. And really, I've always wondered, like, where do people go when they don't have these loans? You know, I've written, we know that from surveys, people will say, well, I'll sell something, or I'll borrow from a friend, or I'll do.
Well, hang on. And borrowing from a friend. Yeah. There was that guy from Pew Charitable Trust. His name was Alex Horowitz. He told everybody in the country, look, if you have your subprime lender go out of business because of a rate cap, don't worry. You can just borrow money from a friend or a family member. I could not believe how far removed from reality that sentiment is. I mean, they just don't understand the reality of people don't borrow money from friends or family, and you shouldn't borrow money from friends or family if you want to keep them friends or family.
And I've always said, people are going to do, whatever, sell something, they're going to borrow from friends, or worse, there's this, that, or the other, or worse. And I mean, nobody ever fills in the blank with you or worse, but I will. I mean, the fact is that if somebody's really desperate for money, they're going to move into illegal activities, and so
that's what we're seeing in New Mexico.
Yes.
That is exactly what we're seeing in New Mexico, Dr. Kaiser. They have literally this well-intentioned policy. We got to stop saying that. We got to stop giving them any credit at all, because sure, they might think it's well-intentioned, but it's asinine and it's stupid.
Yeah, that's exactly
rate caps,
right.
Price controls are stupid. There is no other way around it, because when you institute a rate cap, you're implementing a price control, and that price control creates a marketplace that is ripe for abuse, because nobody has any other options at that point. When you're eradicating the legitimate supply of credit, you're not eliminating the demand, but now you're reducing the availability of legitimate legal credit. So people are turning to these alternative options. And in this case, in New Mexico, we're clearly seeing it. It's illicit. This woman has become a loan shark to her own employees. And the business that she's operating isn't even a lending operation. She's not licensed to lend money in any way whatsoever, but that's not stopping her. That's not stopping her from lending money to her own employees in excess of 2,700%. Her name is Tara Jaramillo, by the way. She was a former representative in the state of New Mexico. She's a member of the Democrat Party. So I hope I'm in the friendly company as we're talking about this. But I couldn't believe that story.
You can't.
I could not believe.
This all also goes to a psychological issue too. I think Americans have become a very id-dominant society. They're very much about the pleasure principle. What I want, when I want it now. I'm not going to wait for it. I want money in my pocket so that I can indulge in whatever it is that I want. They don't like to have to wait. Heck, they get mad because Amazon takes an extra day. So that indulgence, or that lack of, if you want to call it self-discipline, just feeds upon these predators, this financial predator. And it's just, I cannot, 2,700%. I just can't even right now.
So one of the issues is that
the 2,700% problem is a problem that comes from the annual percentage rate mechanism for identifying loan cost. I mean, I think APR is in effect broken when you're applying it to a loan product that is borrowed for less than a year.
I was just going to say,
APR, annual percentage rate. It's annualized, right?
Yeah, I was going to say the same thing. If you needed $100 today, and you came to me and I said, yeah, I'll give you $100, but you give me $101 tomorrow, you'd probably think that was a good deal. But that's what, 365% or something.
It is. It's 365% interest. And when I'm saying 2,700% APR, it's a $125 loan, and they're paying back $135 after 2 days.
Right.
That's
right.
The interest rate, the effective interest rate, the effective APR of that specific loan product is somewhere in excess of 2,000%.
Yeah.
So when you're talking about APR and small dollar loan products, it just doesn't compute anymore.
No, because for most people,
the loan product isn't annualized.
No, right. For most people, it's for a lot of these small dollar loans, it's an emergency loan to get people by to the next paycheck. So it's 2 weeks or 4 weeks or something like that. And so the annual percentage rate makes no sense. And, that 36% was something that kind of came out of the air. There was I think you probably know this, Patrick, but there's an academic about 100 years ago who determined that on a fairly sizable loan that most lenders were willing to loan the money at 36%. So all of a sudden this became this magic number that all across the country is what everybody's aiming to have to cap the rate at, and it's just they don't even understand. It doesn't come from
Dr.
anything
Kaiser,
sound.
Let's break down like a really traditional, widespread, widely adopted loan product like a mortgage. At the current rates in excess of 6%, if you're borrowing money to buy a home and you're borrowing it at that current 6% rate, over the lifetime of a 30-year mortgage, you are more than doubling the purchase price of your home.
Exactly.
If you factor in the interest, right? How is that? How is a mortgage not perceived as predatory when you're doubling the purchase price? But a $101 repayment for a $100 loan that's borrowed for 24 hours, somehow that's 365% APR, and everybody's offended.
Exactly. No, yeah,
you're taking advantage of poor people. You're such a predator. Yeah. I'm like, no, the mortgage companies are more predatory than that.
Right. No, and the thing is that what gets me too is that the people who get into these, who want these loans, they need them, first of all, but not only that, but they're actually very knowledgeable about them. And when you look at the offerings out there in the market, when you go into some of these places that offer these small dollar loans, you walk in and it's like walking into McDonald's. There's a menu and it tells you what the price is of what you're getting. When you walk into a normal bank, there's nothing like that. You walk into a normal bank and it's like, what's your rate? Well, it depends on who you are.
It's hidden in the fine print. It's hidden in the fine print. You have to apply for the loan and then we'll tell you what the rate is.
Yeah, and it depends on who you are, what your rate is going to be. And so, when you walk into one of these small dollar loan operations, it is really clear, and the people who use them use them multiple times, so they know what they're getting into, and they know how the program works, and they know exactly how much they're paying back, and when those offerings get taken away from people's options, then they are left in seriously dire straits. And just to put a point on it, the people who are often the most affected by these are the people who are on the margins of our society. It might be a woman who was recently divorced. It might be a recent immigrant. It might be a young person who hasn't got a credit rating yet. But it's often people who have a bright future, but they just need a short-term emergency. I mean, we've seen the statistics. There's, how many people is it that couldn't afford a $400 emergency expense if they were faced with one today? It's a high percentage of people, unfortunately, and those are the people who are talking about. Well, Patrick, we need to go to a break, but would you be willing to stick around for the next segment? Because I know I want to talk to you about the study you did using Minnesota students.
Yeah. Let's do that. Let's go to break, right. And I'll stick around.
We'll be back in a moment with the Jack Tomczak Show. Welcome back to the Jack Tomczak Show. This is Dr. Kent Kaiser substituting for Jack, who is out for the day. And along with me is Jill Voyevich-Lobs from the Minnesota Republican Party. And we are continuing our discussion with Patrick Brenner, who is the president of the Southwest Public Policy Institute. We're talking about interest rate caps on loans, and we're talking about these small dollar loans that people take out in an emergency, and that's a loan that's typically between $50 and $1,000, and so you can tell people are pretty desperate if they're taking out a $50 loan, but the average loan is $375 for these people. And so we're talking about small dollar loans, and unfortunately the way they're characterized is having high interest rates when, of course, the things that are rolled in there include the fees, and it costs just as much for a lender to put through a loan for $50 as it does for $5,000 or more. And unfortunately, then, of course, that rolls into the APR and makes it look really high, and then that makes it look terrible and evil and like usury and so on. And, of course, the APR is really not a very good measure of what the cost of a loan is or the value of the loan to the person who's taking it out. Most of them are very knowledgeable about what they're doing when they take out the loans and really need the money and are very willing to pay what they need to have that short-term emergency brought to an end. And Patrick Brenner has done a lot of research.
Before we get into the topic about the two University of Minnesota students, I want to mention that it's not always desperation. It is not always people in dire straits that are borrowing this type of money.
That's true.
In fact, in New Mexico, we've seen studies from the FDIC, the Federal Depository Insurance Corporation, where they've defined the greater metropolitan area of Albuquerque as upwards of 30% unbanked or underbanked. Now, whether it's by unfortunate circumstances or by choice, these people are not using traditional financial institutions like banks and credit unions. They don't have checking accounts. They don't have savings accounts. And sometimes that's a matter of choice. And whether it's because they don't trust traditional banks or they just prefer the straightforwardness that they used to be able to get from a non-traditional financial institution in the form of a short-term small dollar loan, they chose that. They had the choice to be able to make that decision on their own. But now in New Mexico, as well as in Minnesota, you're not allowed to borrow that kind of money anymore because the government knows better and you're too stupid to know how to spend your money. I can't stand that mentality.
Yeah, no, I totally agree. And one of the issues, and this feeds into the study that you did here in Minnesota, is, there's these short-term loans and they have these interest rates of whatever they might be. Some of the larger financial institutions supposedly have small dollar loans that they can offer for lower interest rates. And so that's one of the things the policymakers will often say, well, the bigger banks like U.S. Bank and so on, they have these small dollar loans that a person can get if they really need to, and they have a low interest rate. But your research has shown, you have a couple of different studies, there's no loan for you and no loan for you too. Your studies show that while these loan products exist on paper, they don't exist in reality. Is that true?
I would say that is an absolutely true statement, at least from the perspective from our empirical analysis.
So tell us about the study that you did in Minnesota and with the University of Minnesota students, who I know loved working with you. Right. I know them both.
That was such a pleasure, and I hope that they got a good learning experience out of it. The two individuals were Jack Radomski and Brandt Kringlie, and you can find out more about the Southwest Public Policy Institute's report called No Loan for You Too at southwestpolicy.com.
And they are both co-authors on that paper, which is a real feather in their cap, I think.
Well, and they put their own personal banking history on the line. I mean, they had to actually apply for a short-term small dollar loan from the institutions that we assigned them to. So what happened was, in the aftermath of the rate cap in New Mexico, interest rate cap is capped at 36%, and then Pew Charitable Trusts, that Alex Horowitz fella who says if you can't find money from a non-traditional institution, just go borrow money from a friend. That fella. Alex Horowitz published a study that said 6 of the 8 largest banks in the United States are now offering an affordable short-term small dollar loan. Now, of those banks, 4 had branches in the state of Minnesota, which already has an interest rate cap in effect. It's 36% on any sort of payday loan. Those 4 banks are U.S. Bank, Wells Fargo, Bank of America, and Huntington Bank. Now, we tested 3 of them in New Mexico. There was U.S. Bank, Wells Fargo, and Bank of America. With Minnesota, they have a branch of Huntington Bank there, and we were able to assign Jack and Brandt to go apply for a short-term small dollar loan from Huntington Bank too. The problem with these bank loans is that you're required to be an existing consumer of their loan product or of any financial product from one of these banks, whether it's a checking account, a savings account, whatever. You have to have interbank banking history, and they use that as a mechanism to avoid full underwriting. I mean, typically with a short-term small dollar loan, you still have to go to underwriting, which is an expensive process. So to alleviate that cost, all of these banks were using internal banking history from these consumers that were looking for an alternative loan. So when Jack and Brandt both applied for a short-term small dollar loan product at these 4 banks, they were denied access to any sort of credit product because they didn't have any internal banking history with any of those banks. Now, the same thing holds true with the credit unions. So in the No Loan for You Too study, we applied for those financial products from those banks, just like a $500 loan from U.S. Bank. And what's required is you have to have a checking account for a period of time. I think with U.S. Bank, it could have been like 6 months or maybe 12 months, but you also have to have recurring direct deposit history. And they didn't have that because they never banked at U.S. Bank or any of the other banking institutions. What we also found was at the same time of this, where we're taking Jack and Brandt in Minnesota, we're applying for a short-term small dollar loan product from credit unions in New Mexico Now, the banks were bad because they rejected us and didn't give us a real reason as to why we weren't allowed to take out one of these short-term small dollar loan products, which at the time I had a credit score that was pretty close to 800, so I was certainly well qualified. I don't know what Jack and Brandt personal credit history was before they applied for these loans. But when I started applying for the credit unions, they took my credit score to the cleaners. So when people love to talk about how great their local credit union is, I have no idea what they're talking about because the credit unions in New Mexico just brutalized my credit, and I saw it fall over 100 points in my application for a short-term small dollar loan product from one of those credit unions. I think we did 15 credit unions in New Mexico, and all I was looking for was a $500 loan. I saw my credit score drop by 100 points.
We've got 15 seconds left, Patrick. Can you tell us where to find out more information about what you're doing?
Go to southwestpolicy.com. You can find the study, No Loan for You and No Loan for You too there. Thank you so much, Dr. Kaiser.
Thank you.
It was a pleasure.